Thank you so much for staying with us. My guest is the Director of Research and Strategy with Chapel Hill Denham, Mr. Tajudeen Ibrahim. Thank you so much, Mr. Ibrahim. It's good to have you on the show.
Thank you for having me on the show.
All right, then. I think we should start with the reduction that we've seen again. There is another easing with regards to inflation, which now stands at 20.12% from 21.88%. Let me ask what Chapel Hill projected, and with what you've seen, how does it come to you?
So it came in positive and better than expected from two perspectives. The first perspective is our expectation. Our expectation at Chapel Hill Denham was around 21.6%. And interestingly, from the second standpoint, the inflation number also came in positive, better than expected, based on Bloomberg consensus. Bloomberg consensus was for a 21.6% inflation expectation. So, which means the number that was published was a positive surprise to us at Chapel Hill Denham, and also a positive surprise to the market when we talk about economists' expectations. So that is the way the number played out positively.
Good. All right then. It's a fifth consecutive month of reduction back to back. In your thoughts, do you think that this would continue moving forward?
I think most likely we are going to see this disinflationary trend sustained over the next couple of months, because there are no strong indicators that suggest that it could go otherwise. So most likely we are going to see inflation go below 20% before we end the current year. And my sense is that while that sounds positive, I recognize the fact that there is going to be a base effect, and that base effect is going to reflect in December. By December, most likely, we will be talking about inflation rates that is close to 30%. And that, to my mind, will be like a major shock for the economy in terms of expectation. It is not necessarily because prices of goods and services will be rallying excessively, but it is going to be because of the the rebasing impact of the consumer price index. So that is the only downside risk in terms of my expectation for the remaining part of the year. But when we now look beyond that, December number, which is most likely going to be very close to 30%, from January onward, we will begin to see normalized inflation rates that looks like 20% and below 20%. So I just reckon that the Nigerians should watch out for that development, and also co-economists should watch out for that. It is not going to be a deal breaker in my view. It is just going to be a trend that will reflect the impact of the rebasing of the CPI.
The issue of month-on-month inflation, which is worrisome of course, for analysts like you two, what do you make of that, vis-a-vis the fact that reports also shows that we might be, the way it is, we might be getting to harvest season very soon, low purchasing power of Nigerians. How do we marry all of this together?
I think there are two key elements that are on the table for consideration when we talk about the month-on-month, inflation number. Number one is that we have a situation where month-on-month inflation came in at 0.74%, the lowest, in 2025, which I find remarkable because number one, it is the lowest. Number two, it was the major support of the disinflation that we saw in the month of August, considering the fact that core inflation when we capture energy, and core inflation when we remove energy. Both of them went up in the month of August on a month-to-month basis. So what that implies is that the food inflation that really moderated month on month was the major driver of the disinflation that we were able to see on a year-on-year basis in the month of August. Two key things to bear in mind in that regard. Number one, we had a situation where energy prices, or let me say the energy sub-index, reflected this deflation. This is not disinflation, but deflation, in the sense that energy prices, generally speaking, in the basket, were broadly speaking down on a month-on-month basis in the month of August. Number one. Number two, to bear in mind is that farm produce, the sub-index for farm produce was also down, and it reflected deflation, which means that the prices of farm produce, generally speaking, in the basket were down, which reflected lower prices, not just slower increase in the rates, but much lower prices that resulted in deflation of 0.24%. Which we can call negative inflation. I believe that the harvest season is supportive of what we saw in farm produce on a month-to-month basis. I believe also that the local refineries that are already operational, and the fact that some of them are already cutting prices, particularly talking about Dangote refinery in this case, I reckon that that is also reflected in what we saw in the deflation number month on month in energy sub-index. Going forward, I reckon that most likely we are going to continue to see favorable number when we talk about energy sub-index, and there are high chances that we'll also be talking about favorable number when we talk about farm produce over the next 2 to 3 months on the back of favorable harvest, and also on the back of little or no flood event, because flood event most likely will be the major downside risks.
So let me ask what a layman will want to know, of course. Well, how will this, or when will this start to impact on all that we buy in the markets? Grains, foodstuff, and all of that. That is what the man on the street wants to hear of. When he hears inflation is easing, he wants to know how that impacts and put foods on his table.
Absolutely. I reckon that, if we go to major markets, we realize that, for food products that are currently being harvested and, being sold in the market, their prices are, a lot much cheaper, compared to, what they were before the harvest season. We currently have a situation where we currently are seeing food products such as yam, for example, and that is what we call new yam, being sold in the market. You compare to before, we had new yam in the market. So we are beginning to see the positive impact of harvest in that regard. And I think also for plantain, that's another major food item that where we are seeing more favorable prices in the market compared to the previous levels. So I think the masses should observe all of these elements, because harvest season, naturally speaking, ushers in slightly lower prices, if not, large, decreases in prices of food, which is a major thing for consideration here. Particularly when we remove the impact of bad roads, we remove the impact of, poor, saving culture or preservation culture. I think in terms of the output, the outlook and what we currently are seeing in the market are favorable.
I see state-level inflation, particularly food. Borno, Kano, and Akwa Ibom were on the high side, while for Sokoto, Zamfara, and Yobe, they were on the low side. Looking at the percentage figures here, I'd like you to react to that.
Well, I think, each time you see food inflation, from all of those states, I think in my mind, two things really pop up. The first thing that pops up is the activity of farmers in those areas, particularly on the back of security level in the areas. So in the areas where we have little or no security threat, you largely speaking would see that they would be recording favorable inflation, particularly when we talk about food inflation. But in areas where we have high level of insecurity, where farmers are unable to cultivate their farms, you would see high level of food inflation in such area. The second element for consideration in my mind is flood events. When you have flood events in some of those or many of those food producing regions, you would not see favorable food inflation number come out of those regions. So those two key elements to my mind are very, very important. The third element for consideration is logistics. How easily they are able to transport all of the farm produce to the market, because if it is at a relatively high rate, then food inflation in all of those states most likely will be elevated. I think that is the way to view all of those numbers when we talk about food inflation in those states that you have mentioned.
Now, with the level of stability seen or witnessed, 20.12% is where we are. Many would say that this could help the Monetary Policy Committee to start to rethink their stance, considering the fact that it's been tightening all the while. Do you think that they might start to consider loosening?
So no doubt, my sense is that they will begin to discuss, going dovish from the meeting of this month. But I think, there is still more, for them to observe, particularly, number one, the sustainability of the month-on-month disinflation that we saw in the month of August at 0.74% month-on-month. It is important to see how sustainable is it over the next 2 to 3 months. The second thing for consideration in my mind is that expectation for December, which is going to be like the highest for year 2025, which I estimates to be around 30% due to base effect because they rebased the CPI. So if there is a rate cut in September, it will be too early. So I do not expect a rate cut this month. But it is possible that we see some level of small rate cut or the adjustment of the asymmetric corridor around the monetary policy rate in the month of November. I think that is possible, particularly when we consider what is currently happening in the financial market as the CBN is allowing liquidity to build up. A build-up of liquidity over an extended period of time is, to my mind, a signal around the possibility of a rate cut or the adjustment of the corridor to the MPR anytime soon. So I think the earliest we should expect a rate cut is November of this year, and to my mind, it could be as late as January 2026, just because of the expectation around a spike in inflation in December.
Interesting stuff, because even the Federal Reserves in the U.S., their expectations that they might be loosening very soon as we move forward. Do you see any of these global developments also shaping decisions down here?
So one of the major global developments that can shape the decision that we make here on the monetary policy front is what the U.S. Fed does. This month around rate decision. If they decide to cut interest rates, I think it will embolden frontier markets, generally speaking, those that have not really cut interest rates, particularly Nigeria in this case. It will embolden our central bank to begin to think about going dovish as well. Bear in mind that we have the foreign portfolio investors in this market, largely speaking, having huge positions in OMO bills, which means that we are supporting our FX reserves with the bulk of the OMO investment by the FPI. So if we now are having a dovish monetary policy stance in the US, it will encourage the Nigerian Central Bank to also begin to consider cutting interest rates gradually. I reckon it has to be gradual because an aggressive one can result in capital flight. And when you have capital flight, you put pressure on the exchange rate. When there is pressure on the exchange rate, it can lead to higher inflation. Higher inflation will, naturally speaking, necessitate that you begin to hike interest rates again. And that, to my mind, will look like policy inconsistency. And I reckon it is not something that the CBN would like to do. That is the reason that I reckon that any rate cut in Nigeria, will, largely speaking, be mindful around what, the US Fed does this month or possibly the next time that they meet. And I think we cannot afford to be aggressive in the current period. It could be costly for the economy, in my view.
Mr. Tajudeen Ibrahim, I must thank you so much for your time. Director Research Strategy, Chapel Hill, Denham. Do enjoy the rest of your day, and thanks so much for your contributions to the show.
Thank you for having me.